Hello and welcome everybody. Happy Friday, welcome to the end of another trading week and a 3-day weekend. Monday is a holiday, both for most people that work Monday to Fridays, but also for the market. So next week we're only going to have 4 trading days in the week to talk about. But today I have a continuation of a topic actually. On Tuesday, members and I talked about what the different layers of the market are, turning the market in both the US and international stock market into a giant onion, and slowly peeling back layer by layer to talk about all of the different layers of the market, and more importantly, how you can gain access and exposure to all of these different layers, even if you're inside of the US, through things such as ADRs and mutual funds and ETFs. But one thing that we talked about in that webinar was the final 2 layers. Once we get to stocks, we can't just stop there. We need to continue. We need to talk about preferred stock. We need to talk about share classes and all of these concepts that we haven't covered yet on this channel and from Sectors Made Simple. So today we're going to be filling in those gaps. We're going to be talking about share classes, both between common and preferred stock, and by the end of today you'll know what those mean, as well as the different share classes within common stock. So that's today's topic, but before we get started, there is something very fun that I want to announce to you all. Nate has been working very hard to create a new website for Sectors Made Simple, to allow you to explore our content simpler, but also to make buying a subscription, managing your subscription, and managing your account simpler as well. And today, I'm pleased to announce the release of that new website. So before we get into today's webinar, I want to quickly show off the website and a promotion that we have going along with it. So, ta-da! Here is the new website. It's still available at sectorsmadesimple.com, but the new design offers a lot of quality of life improvements. We offer the ability to create an account much easier. We allow you to explore. There is usually a video here, but because I'm on incognito, it's not showing. But bear with me, there is something there, I promise. Links to both subscribing, the SMS Learn site, as well as our YouTube channel, which is where all of you are right now, and the big announcement. We now have, in addition to our annual subscription option, which is available, we also offer 3- and 6-month memberships. These 6- and 3-month memberships do come at a little bit higher of a cost, but offer many of the same benefits that Sectors Made Simple annual subscribers get. You get access to the dashboard, you get access to all of our members' webinars, you get access to our apps. The only things you don't get are the price lock. So if we raise the price in the future, we will notify you, but your cost will change, as well as you don't get discounts on things such as Spreadsheets Made Simpler Advanced and other future standalone courses that we have. So there's now the option for 3-month, 6-month, and annual subscriptions. And to celebrate the release of our new website, if you use code SMS10 at checkout, you'll get 10% off your first period. What a period is whatever it says here. If you buy the 3-month and you use the coupon, you would get $25 off your first 3 months of your subscription. If you bought the 6-month, you would save 10% on your annual subscription, and also get $45 off of your first 6 months. If you buy the annual, you save 25%, your price will never go up, and you save 75% on your first year. So you get the first year for $675. There's never been a better time to join the Sectors Made Simple community and start learning how the matrix, the strategies we provide through it, and all of the information that we offer to members helps you to invest simpler. So please enjoy the new website. If you have any feedback or questions for us, you can always send us an email at support@sectorsmadesimple.com. Now, we got the promotion stuff out of the way. Let's get straight into the content. So today's webinar is all about share classes. $75 off, correct? Not 75%. It is 10% off the annual cost or the 6-month cost or the 3-month cost for your first period only. So again, first period only. So let's go through today's topic and what we're going to actually be covering for it. Today we're going to talk about what share classes are, what the difference between common and preferred stocks are, the differences between Class A, B, and C shares for stocks, and the differences between Class A, B, C, and a couple of others for mutual funds. And the last thing is we're going to cover some of the other weird share classes that exist and why they exist. Really quickly, I want to review what we talked about last in the members webinar. I want to show off the same onion graphic that we talked about, where we start off with the big circle that has everything inside of it. World stock markets. That's the US and international stock markets. Then we have our US stock market, which is the US exchanges and indices, market sectors, industries, companies, and finally, we get into today's topic, preferred versus common stock and share classes. So what exactly are share classes? Because in reality, when you buy a share of a company, it's pretty simple what you get. You get an asset that is part of a company. You now own part of that company, and that right to that company, or your part of that company, has privileges and rights and lets you have certain benefits. These benefits can include, but don't have to include, dividends and voting rights within company decisions. But not all shares are equal. Some shares do have priority over others. Some are given better treatment than others. Some shares offer more or less voting rights. Some offer more or less dividends. Some guarantee dividends. Some don't guarantee dividends. And some other things that we'll talk about today. For example, everything when we're investing in a company relies on that company existing. What if it goes the way of Blockbuster or Evergrande, where its future is a little less certain? What happens if they go bankrupt? What happens if they're forced to sell off assets in a process called liquidation? Who gets paid first? That is something very, very important for us to talk about. And to do this, we're going to go to our first topic for today's webinar, preferred versus common stock. Both preferred and common stock are shares or stock, where they give you access to ownership of the company, and if the company offers dividends, will give you exposure to those dividends as well. Common stock is the kind of shares that most of us are used to buying. When you go to Fidelity or Schwab or whoever your broker is, and you say, go buy a share of Tesla, you are talking about common shares. They are thinking of common shares. Common shares are the big majority of our topic. There's thousands of common shares available in the stock market in the US. We're going to talk about those later. So take common stock, stick it over here. We'll come back for our common stock. For right now, let's focus on preferred stock, because that's going to be the thing that is a newer idea for many of us. So let's compare preferred stock to, instead of thinking the word common stock, just think the word stocks as you would think about Tesla or Microsoft or the stocks that you buy and sell already. Preferred shares are, or preferred stock, we can use those two words interchangeably, or we can flip them whenever we want, are the shares of a company that kind of work similar to shares and common stock, but also work similar to bonds and other debt securities. Like common stock, preferred shares can be bought in a stock exchange through a broker. So they're listed on the New York Stock Exchange, their price is tracked, and you can go to your broker and say, hey, go buy me 5 shares of preferred stock for this company. Now, these shares are pretty similar to common stock, to the stocks you already know of. They give you ownership. If you own a preferred share of a bank, or let's say Bank of America, congrats, you now own part of Bank of America. And another cool thing about preferred shares is that they can be converted. If you own preferred shares, some companies, and honestly most companies, offer you the ability to turn your preferred shares into common shares. And the way that they'll do this is they'll say, we have a ratio of 1 to 12, for example. So you can take 1 preferred share and exchange it for 12 common shares. Not a bad deal, right? Now, here's the big difference when we're looking at the stock side of all of this. Unlike common shares, that most common shares let you vote on company decisions, preferred shares have no voting rights. You do not get a say in what the company does. All you get is whatever that share is valued at and dividends. And this is where we get into this idea that preferred shares also share a lot in common with other debt securities such as bonds. Preferred stock offers significantly higher dividend yields, or they offer a lot higher dividends than you might get through your stock in that company, common stock in that company. For example, preferred shares usually will have dividend rates around 4 to 5% on the low end, 11% on the high end. That's really big dividends. That is a huge percent of the value of that share given out as dividends every single year. Now, preferred stock, much like bonds, are rated. So Moody's and Standard & Poor's will rate and grade preferred stock. And just like bonds, there is investment grade versus junk preferred stock. And additionally, preferred stock is not thought of as stock when we look at the number of shares outstanding or the shares float. They are included on the balance sheet. They are considered to be investments and investment assets, but they are not included in shares float or outstanding numbers. And here's the big topic. They are given priority in the event that a company either liquidates, where they start selling off a bunch of stuff to cover debt, or they file for bankruptcy because they can't pay their debt back. Now, let's go into because now we've talked about how they're similar to bonds and similar to stock. Let's just have it all in one sheet. Preferred shares come with dividends. And this is going to be the big topic here, because these dividends are what you care about if you are buying preferred shares. It's not realistic that a company is going to go bankrupt. That happens for For S&P 500 listed companies, pretty infrequently. These are extremely large companies that for them to go completely bankrupt or to have to liquidate and pay out shareholders is a big deal, and that does not happen often. So let's focus on the other reason that investors like to buy preferred stock, which is dividends. These dividends are paid out on either a quarterly or on an annual basis. So what that means is they might pay you out quarter 1, quarter 2, quarter 3, quarter 4, or they might only pay you out once a year. Additionally, you know how when you own shares of a company like Disney that pays out dividends, how you kind of just get whatever they want to give you? That's not how it works for preferred. Preferred, you're given access to the fast lane. It's like buying the fast pass at Six Flags. So what you end up getting here is a fixed dividend rate. When you buy that preferred stock, they tell you what your dividend amounts will be, and that is annual. Like clockwork, every year you get those dividend payments, and it's the same percentage, more or less. And here's the crazy part. Bonds also offer fixed interest rates. You know when you buy the bond how much dividend payments you're going to get and how often you're going to get those payments. But they also expire. Bonds have a date where at the end of that date, they pay back the initial amount, and that piece of paper floats off and is no longer worth anything. Preferred stock does not work like that. For preferred stock, they have no maturity date, which means that they never expire. So you keep getting those dividends over and over and over and over for as long as that preferred stock exists. But preferred stock can, let's use quotes and use this word very loosely here, can expire. They can turn into nothing. But the only way that that can happen is if the company that issued it does what's called a call. Much like options, where calls give you the right but never the obligation to buy, this is exactly how calls work for preferred stock. What the company can do is they can say, hey, Juan de los Palotes, you have a share of my preferred stock. I want to buy it back from you. And they have the right to buy that share back. Now, usually they'll have to pay a premium. They need to pay extra to give you those shares back, and there might be some rules and regulations around it. Usually, it's not simple, or it's not profitable for the company to call back these shares, but they will do it eventually because it's a liability. Having them just giving out dividends indefinitely is a lot. So eventually, and usually after many, many years, they will call back all of or some of their preferred stock. Now, what do they buy it back at? How much do they pay when they buy it back? There is, much like a bond that has the face value, they will have a value for a preferred stock share. That is how much they will pay you back at the end. When they want to call those bonds, or when they want to call those preferred stocks back, they will pay you out the rate that that share is worth, or what's called the liquidation value of it. Now, I said a very important word there that I want to talk about. Liquidation. And before I do that, let me turn on the lights really quick because it's a little dark in here. And then Jonathan said, let there be light. Alrighty. Let's now get into the topic of liquidation and why liquidation matters for preferred stock. When a company goes bloop, 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 belly up, they die. Let's not have to use the we took the goldfish for a walk and never came back example. When a company dies, goes bankrupt, whatever words you want to use for it, they still are liable to pay back people, because people like you and me and Juan de los Palotes, but also banks and contractors and everyone that had business with that company, they're all, what, are they just out of luck? Is their money lost? It's not how that works. So when a company with common and preferred stock has to sell, they need to sell stuff because they filed for bankruptcy or because of other reasons, what's going to happen is they need to start choosing who gets paid back and who gets paid first. So here's the order. And again, do you need to worry about this stuff? Not in your everyday life, but it's my job to give you all of the information so that you, if you ever see this, if you ever see preferred stock, you know what it really means. And this is one of the biggest differences between common and preferred stock. So when a company goes belly up, they die. Who gets their money? They don't have a living will, they don't have a will and testament, the last desires of Blockbuster, let's say. Instead, these are pretty clear rules. Who gets paid first? What's called secured creditors. People like the banks that loaned the company money. Or lenders that in exchange for that money asked for collateral. Hey, that's a beautiful building that you have there. If you can't pay me back, I want that building. Those guys get paid first. Then we go to the unsecured creditors. These are the people that they still lose money here if the company can't pay them. But it's suppliers. So people that they owed money for materials or for inventory. Contractors, employees that they haven't paid the wages for. If a company is losing money, they might say to their employees, hey, I'm sorry, we can't pay you. We have no money to pay you. So after the banks get paid, those employees get paid as well, or customers might get paid as well if they are in need of reimbursement. Then, preferred stock. How much do they get? Well, it depends on the liquidation value. And I saw Irene's question about, can you give an example? I'm not going to give you an example. I'm going to give you every single stock, preferred stock that is traded on the US exchanges. How about that? So again, preferred stock now is paid back at whatever the liquidation value per share is. And I'll show you that in one moment. Then, after everyone and the dog has been paid, they would pay back common stock. So let's go and take a look at all of these preferred stocks so that we can see this a little bit more clearly. I will post this link in chat right now, as well as if you're watching this recorded, it will be in the description section under the resources. This is the list of the 575 preferred stocks that are currently traded on the on the US stock exchanges, not just the New York Stock Exchange. What you're going to see is a couple of things. You're going to see who issued it, what's the name of the company, and what's their ticker. Then you're going to see the symbol for that actual thing, for that preferred stock. Then you have the liquidation value. That is what the original price was. That's what it's traded for. Not what it's traded for. That's what the coupon rate would pay out. So it would be 7% of $25. And lastly, we have the coupon rate. The coupon rate is going to be what the percent dividend they pay out is annually. So if they pay out in 4 quarters, you're not going to get 7% every quarter. Instead, you're going to get 4 payments that at the end of the year would add up to 7%. Then there's one last thing that we didn't talk about here, but is worth mentioning. Fixed to floating. Fixed to floating is an idea that at a certain point, that coupon rate might change or might need to change because of interest rates, because of whatever reason. That fixed coupon rate that you started at, that 7%, might need to change. Now, what does fixed to floating mean? What that means is at a certain point, the company can say, we are changing the interest rate. It is no longer 7%, or sorry, not interest rate, coupon rate or dividend rate. It's no longer 7%, it's now 9%, or it's now 5%. They can change to whatever they want it to be. So then what's going to happen is they need to tell you when they can change it. You're buying a security. There is rules to how they can do things. So it is fixed for a certain amount of time, usually about 10 years. After that 10 years, they can then change the coupon rate. Pretty simple. What they change it to, there's no clear example of this. So now, let's go and let's continue looking through at our presentation. And now let's go and talk about common stock. Because we've covered the basics now of preferred shares and shown you where you can look up preferred shares. But the one thing that we haven't talked about yet is common shares. Common shares are what we're familiar with. It's a share of a company that you can buy off of an exchange and gives you partial ownership of that company and usually voting rights in that company for decisions that the company makes. But we also can talk about common stock for a mutual fund. And much like companies, some mutual funds will have what's called a fixed number of shares. They say, we have smashed ourselves into 1 million pieces. There's only 1 million pieces of us to go around. That's it. But there's also what are called open-end funds, where they can issue more shares whenever they want. They can print more shares and issue more shares to their heart's content. So it's pretty simple to understand. Now, let's go and talk about what classes exist within a company. Because just like there's a difference between preferred and common, there's also differences between the different types of common stocks as well. And I promise you, you've probably seen some of these differences. Sochil is saying, is anyone having issues loading the SMS website on Chrome? I get a spinning wheel every time I click on the Matrix tab. Let me try that myself. So what's happening is that you need to probably log in again. If you can, try and go directly to the Matrix and see if you can log in there. Once you've logged in there, you should be good to go to click on the Matrix link from the website. If you still can't, what I recommend doing is deleting the cookies for a single website. Let me send some instructions on how you can do that. there's instructions on if you need to clear your cookies. So first, try going straight to the matrix and logging in again. So log out and log back in. If that's still not working, try and delete your cookies for sectorsmadesimple.com. If you're still having trouble, send me an email and we'll get you all sorted. So now, back to our common stock classes. What we end up having here is a bunch of different share classes. And you probably have seen some of these different share classes. Maybe you've wondered, why does this one company have 2 listings? So it's important for you to know. Preferred stock, I don't expect most of you guys to use that information. It's good to know because now you know it exists, and if someone starts talking about it, you'll know what they're saying. The different types of common stock you need to know. Most common stock gives voting rights, as it should, and can be bought and sold on major stock exchanges like NASDAQ, Amex, or New York Stock Exchange. Also, some share classes can be converted, where you can turn Class A shares into 5 Class B shares, and so on and so forth. Now, what changes isn't common versus preferred, but instead the share price and what those share prices or what those shares for the different prices give you. Now, for mutual funds, it's a little bit different, and we'll talk about mutual funds a little bit later. But for mutual funds, what it changes is what you pay in expenses and when you pay those expenses. But again, we'll take this slowly, bit by bit, so everything is simple to understand. First, let's talk about stocks and talk about the 3 main share classes that exist. Instead of using a bunch of words, I'm gonna use examples. The new SMS will be an iOS app. We already have an iOS app available. So you can find our app by going to the App Store and looking up Sectors Made Simple. So I'm going to use examples of companies that you all are probably familiar with to show the differences between these different classes. Let's start off with Class A and Class B shares. Class A shares are typically more expensive per share and carry more voting rights than Class B shares. Using the example of Berkshire Hathaway, we can see this pretty clearly, where we have BRK.A for Berkshire Hathaway A shares and BRK.B for their B class shares. And the price difference is hysterical. It is hysterically huge how big the price difference is, and we'll talk about why. Now, other companies, instead of using a .A, .B, .C, they'll just use a completely different ticker symbol for their other share classes. Have you ever wondered why Google has 2 tickers, GOOG and GOOGL? Now you know. It's because they have 2 different share classes. In the case of Google, GOOGL are their Class A shares and have 1 vote per 1 share. Class B shares do exist, but you can't buy them, and they offer 10 votes per share. Class C shares, which is GOOG, offer no voting rights at all. Now, because of the differences in voting rights, and also other conditions that we'll talk about here in a minute, different class shares may or may not have hysterically different prices, completely different prices. Let's look at Berkshire Hathaway. Berkshire Hathaway, on Tuesday when I pulled these numbers, Berkshire Hathaway's A-class shares are traded at $480,340. Berkshire Hathaway B shares are traded at $319.80. Why? Why is one more expensive than most luxury sports cars and the other is an expensive dinner? Well, I'm not going to answer that just yet. I'll talk about that in a couple minutes here. But let's compare that to Google. GOOGL is their Class A shares with a current price of $2,789.61. Their Class B shares. If that's their voting shares, what do you guys think the non-voting shares are worth? It's still Google or Alphabet Inc. It still gives you access to their company. It's still the same company's earnings. The only thing that changes is you can't vote. You don't get a company vote with Class C shares. What do you guys think, after looking at Berkshire Hathaway, what do you think the Class C shares are priced at? $200? $300? Again, Class C has less rights than Class A. How about $6 more expensive than the Class A shares? Wait. $6 more expensive to not trade. Or sorry, to not vote. What? Why? Well, are you trying to tell me here that non-voting shares actually are more expensive? Or I'm going to say the same price, because realistically it's $6 difference. You're trying to tell me that those two things are the exact same price. Yeah, I am. Why? People don't care. The average investor does not care about voting in Google. They don't care about having a say in the company's future direction. And also, most investors think, I have one vote in a pool of billions. Why does it matter? Why should I care? So that's why Google's prices are not different. There are two different shares, and there's a lot of reasons as to why. Mostly that Google's CEOs, when they decided to issue more shares, didn't want to dilute their voting rights, and it's a bunch of administrative stuff. But as far as Juan de los Palotes and me are concerned, if I don't care about voting, Class A and Class C shares are the exact same price. So why are Berkshire Hathaway shares so different? Because remember how I said that companies can treat different share classes however they want? They can give them more voting rights. They can give them less voting rights. They can give one 10. They can give one 20 if they wanted. So here's why Berkshire Hathaway is different. Warren Buffett he's a value investor. He likes buying and holding and long-term trading and being interested in the company's long-term health. So in the case of Berkshire Hathaway, Warren Buffett's company, he has one rule. Class A shares have never and will never split. Those shares are always going to be the exact same number. Never will they stock split. It doesn't matter what the price goes to. He wants those to be worth something, and the value of that share is the value of that company growing over time. Class B shares can and will stock split. The last one was in 2010, I believe, when it stock split. And the other cool thing is they are exchangeable. You can actually trade one share of Class A for 1,500 shares of Class B. But you cannot trade 1,500 Class B shares for one Class A. Again, why? Unlike Google, that the reason that they have two classes is because they didn't want to dilute the owners of Google's ability to have a say in the company, but they wanted to issue more shares. In this case, where Berkshire Hathaway and Warren Buffett are trying to appeal or give something to two different types of investors. The Class A shares are for the long-term buy and hold investors that they believe in Berkshire Hathaway's long-term earnings potential and will buy the share A class because they believe in it. They think it's going to go up over time, and those shares are never going to be diluted. It's always going to have the same weight that it does now. Whereas the B class shares are targeted more towards the average retail investor or the day and swing trading investors that want something more reasonably priced. They're not going to throw $500,000 into one share of a company, but they might throw $600 into two shares of a company. So to them, buying a couple of shares of Berkshire Hathaway B class still gives you access to Berkshire Hathaway. You still get to be part of Berkshire Hathaway's stuff, but it's not $484,000 per share. So those are the three main classes. Class A usually holds the most voting rights and is typically the most expensive. Class B, fewer voting rights, most of the time. Google flips that backwards, where Class A is 1 share per 1 vote, and Class B, which you cannot buy, is 10 votes per share. Now, there are other share classes. I don't expect you guys to memorize this. This is not nearly as important, but it does answer many people's questions of how are Chinese companies listed in the United States. Two ways. One is through N shares. H shares, though, are shares of Chinese companies that are traded in Hong Kong. The Hong Kong exchange allows for non-Hong Kong or non-Chinese residents to invest. These shares are still subject to international accounting standards and are audited as from international sources most of the time, and I'll talk about one case of when that wasn't true. And H shares are also quoted and traded in Hong Kong dollars. These are important to know because you might see a -H or .H at the end of a ticker symbol. That is what those mean. Chinese companies that have a share class that is listed in Hong Kong, but their primary exchange is probably Shanghai. N shares are what you all would see and gain access to if you bought a Chinese company from the US. These are shares, or ADRs, also known as American Depository Receipts, of Chinese companies. These are a share in a company that is headquartered or incorporated in China, but also listed in the US. It sounds crazy, but I promise you, you've heard of companies like this before. Baidu. Baidu is a perfect example of an N-class share. It might not be in the name because it doesn't need to be. There is only one Baidu in the US exchanges, BIDU. And Cleo, if you press that reset button on my computer, I am going to be incredibly sad. Please do not. Cleo's sitting on top of my computer right now, just tempting me with the reset button. No, bad cat. So, Baidu. If you go to, let's say, Google Finance, and you look up Baidu, it is traded. It's traded on the NASDAQ. But it is a Chinese company that is headquartered and centered in China that has receipts available and an N-class share available in the United States under the ticker symbol BIDU. It is still a Chinese company. Alibaba, the exact same thing. But you remember those international accounting standards things? That's the reason, one of the main reasons, that Alibaba decided to drop out or delist from the US exchanges. They did not want an international accounting group to audit them. They're not the only company. There is a couple of other Chinese companies that are looking to withdraw their N-class shares, or ADRs, because of these international accounting standards. Interesting, to say the least. Now, we've talked a lot now about the different stock shares, the ones that you see in the US, but also the international companies, mostly Chinese companies, that you can access as the result of either H or N-class shares. Let's now talk a little bit, about mutual funds. Because mutual funds also have classes to them. Similarly to companies, mutual funds typically issue A, B, and C class shares, but other more institutional facing share classes exist. And I will talk about those just because it's really funny to see what those actually mean. But A, B, and C usually follow a couple of, not rules, but they usually follow a couple of guidelines. So that an A-class share across different mutual funds usually means the same thing. An A-class share for a mutual fund typically carries what's called a front-end load. What that means, load is basically you have to pay them. Just like an ETF has an expense ratio, mutual funds have fees. If you're interested to learn more, we do have a mutual funds webinar that I talk about all of the different types of fees. But today we're just going to talk about the expense ratio fee. The expense ratio for a Class A share is front-loaded. You have to pay that fee when you purchase a share of that fund. B class has a back-end load. What that means is when you buy that mutual fund share, you don't pay the expense ratio. You pay that expense ratio when you sell that mutual fund. And you usually have to pay higher expense ratios than what you would have paid with a Class A. Now, what if you don't like the idea of paying up front or paying when you sell? What if you'd rather pay in chunks? That's C-class shares. C-class shares have what are called a level load. You don't pay up front, you don't pay back, you pay in little bits. So you pay every single year instead, yes, and load is referring to that expense ratio part. And again, I cover all of that in a lot more detail in our mutual funds webinar. But C-class shares, you pay that expense ratio a little bit every single year. You don't pay a lot when you get in, you don't pay a lot when you get out for the expense ratio part. And usually those expense ratios are going to be a little bit higher than those Class A shares. Now, I promised you I'd get into some pretty funny stuff. So now I want to talk about some other mutual fund class shares. These do not matter much to you, me, or Juan de los Palotes. These are going to apply mostly to institutions because these share classes oftentimes require a minimum investment, ranging from a few thousand to over $1 million minimum. But in exchange for extremely high minimum investments, those funds will usually offer much, much lower expense ratios. And yeah, like my mom is saying, expense ratios are the cost of doing business, like rent, salaries, so on and so forth. You can see a mutual fund's expense ratios on morningstar.com. And if you ever go to ETF.com to look up ETFs, let's go here. And let's look up, let's do VOO. Vanguard's S&P 500. I said Vanguard's S&P 500. There we go. Expense ratio. ETFs do charge an expense ratio. How much does VOO charge? 0.03% per year. How about SPY? SPY is also an S&P 500 ETF and is also not loading. Yoo-hoo. All right, spoiler because the computer, I guess it's not a spoiler, answer because my computer doesn't want to show it to you. It's 0.09%. So you pay 3 times higher of an expense ratio for SPY than you do for VOO. Interesting to say the least. Let's see if this one works. Please. Yay. There. Expense ratio 0.03% compared to 0.09%. Kind of fascinating. So understanding expense ratios is very important. But going back to what we were talking about here with mutual fund share classes. Again, this stuff is not going to matter as much for you and me because most of these classes are only accessible, or the amount of investment is usually only needed at an institutional level. So let me give you the example of Vanguard's share classes. These are their institution level share classes. Investor shares. These, depending on the fund, will have an expense ratio from 0.09% to 1.8%, with an average of 0.27. In order to get into this group, you need to invest at least $3,000. For Admiral shares, these expense ratios range from 0.04% to 0.45%, with an average of 0.14. So half of the average expense ratio of my cat is going absolutely bananas over hummingbirds. So half of the expense ratio of the investor shares. How much does it cost you for that lower expense ratio? Try $50,000 for actively managed funds and $100,000 for sector-specific funds. Institutional shares, and this is where things get insane. 0.01% to 1.74%, with an average of 0.08%. Almost a quarter of the investor shares, half of the Admiral shares, and what does it cost you? $5 million minimum investment. So if you got $5 million burning a hole in your pocket, you can get into a Vanguard mutual fund and have an average expense rate of 0.08%. All you need is $5 million. We talked about a ton today. And we didn't just take one topic and go deep into it. We covered everything that is share classes. Mutual funds and stocks, preferred stocks and common stocks, Class A, B, and C shares, and I shares, and N shares, and everything. Let's summarize so that all of that information sticks, and we also get to talk about why you should care. Share classes are everywhere. You've seen them before, and you'll continue to see them. It is the reason that GOOG and GOOGL exist. These share classes also include preferred stock, high dividend yielding investments that in exchange for those high dividend yields offer no voting rights. But as we learned from Google, most investors don't care about voting rights. Now, within share classes, we also have common stock, where these will have different voting rights and rules, like, for example, Berkshire Hathaway, where their voting rights are the same for both groups. A class has a little bit more voting rights than B class, but it doesn't matter because the reason A is so much more expensive than B is A never splits, B does. Share classes also allow US-based investors to buy foreign, usually Chinese companies that are listed through Hong Kong or through N-class shares listed in the US. And lastly, share classes exist for mutual funds, allowing you to choose when you want to pay your expense ratios through front load, level load, or back load. And those will change depending on the amount you invest or the share class that you buy. Before we break for the evening and for the weekend, there's one thing I want to show you all. If we go in and we look at a perf chart between Google and Goog. These are their prices. Same, different. What happened? We'll come back to it. Different. Same on 7/28. They started to differ on 4/27. Same. Why? Why did their non-voting shares all of a sudden start being more expensive than their voting shares? Back in April of 2021, Google announced that they would be buying back Class C shares, only Class C shares, at a premium. So they would give you the price of the share and extra to buy you out. So all of those non-voting shares started to be more expensive. Then, on July 28th, Google announced that in addition to their non-voting shares being bought, they were also going to start buying back voting shares. So now voting shares and non-voting shares could be bought back by Google or could be sold back to Google, which is the reason that their prices consolidated and have been the exact same ever since. People don't care about the voting rights for Google. All they care about is does it make them money. Here, we see that their non-voting shares were actually more expensive than their voting shares because of the buyback program. The minute the buyback program opened for voting shares as well, it consolidated and never changed. Now, again, I mentioned this a bit at the beginning, but I want to say it one more time. Sectors Made Simple today launched our new website. In addition to our new website, we now have new payment options for a subscription, where you can purchase a 3 or 6 month subscription. Additionally, if you use the code SMS10, it's at the top of the website. If you use this promo code when you check out with your new subscription, you will receive 10% off of your first period's purchase. If you need any help or if you have any questions about your subscription, please send us an email at support@sectorsmadesimple.com. We'll be more than happy to help you. But that is all the time we have for today. Thank you all so much for joining us for today's webinar. I hope you all learned something new, and we now understand the market a little bit more, and we can explain the market in a little bit simpler of a way. So thank you all so much. Members, we'll see you back for next Tuesday, where we'll touch on some of those custom matrices that we talked about last year, at the end of last year. We're going to be visiting them again to see what's changed in custom matrices in the past month. And everyone else, I hope to see you all in our webinar next Friday, where we'll we'll cover another very interesting financial topic. Have a great weekend, stay safe, and we'll see you all very, very soon. Take care.